Hello, everyone. Good afternoon. This is Dave Keller from StockCharts.com, global headquarters in Redmond, Washington. Welcome to the final bar today. Well, after 2 days of clear distribution, we have a return of accumulation, right? A little buyers entering into the market, pushing stocks higher. We're going to break down some of the activity. We're going to think about the consumer discretionary sector in particular. And I'm going to have a guest, Mark Newton from Newton Advisors, that's going to share 3 charts he thinks you should watch. Ladies and gentlemen, this is the final bar. Ladies and gentlemen, welcome to the final bar. My name is Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in the Pacific Northwest. Thanks so much for joining us today. Appreciate it as always in this first week of the final bar. This has been a fascinating week. I feel like there are always, every week brings its own excitement, but this week has certainly brought an addition of volatility, maybe more than a lot of us have been used to, right? So we've had a lot of movements, a lot of big intraday shifts, a lot of news flow that's causing things to move around. But again, the goal of this show is to really focus on the visualizations, right? Focus on how and why the charts can help you make sense of all of these movements. Put today's action into proper perspective, right? So we're going to start with a long-term picture of the S&P 500. I've mentioned in my blog, The Mindful Investor, and I've mentioned it on other shows that I've hosted on StockCharts TV. The first thing you look at in the day, the first thing, whatever you start your day with, I would argue has great behavioral impact on you. And so if you're a long-term investor, which I think many of you are, remember to have a proper perspective on the long-term trend, right? Don't get so caught up in the short-term movements that you forget to think about the long-term trend. That's where you're trying to win. That's where the game is that you're trying to focus on. If you're more short-term oriented, good, focus where you need to. But this is a weekly chart looking back the last 7 years on the S&P 500. So it's a very long-term view of the large cap space with the idea of sort of priming ourselves to the long-term trend, right? So here we have the 40-week or the 200-day moving average. Below here is the 150-week moving average, which is a very long-term picture. And again, all of this week's movements, all the fluctuations, all the uncertainty is this little blip within the context of this long-term trend. So I would start with the proper context, right? That this volatility is one piece within a much larger mosaic that you can pay attention to. Having said that, let's look at the action today and think about how it fits into recent price movements. So here we've had the last 2 days. You can see the distribution day that we saw going into Tuesday, Wednesday, into today on Thursday, the rally back. So yesterday with the big gap down, closing just above the 50% retracement level. The thing we talked about yesterday was, do we see some continued follow through? Do we find buyers? When do they come in and how does that actually work? And today we certainly saw signs of that, right? So we opened here, we traded much below. We traded almost down into this, really clear demand area, the support level from August, but then closed up at the highs of the day. This, you could argue, boy, if you're a candle aficionado, you'd call this maybe a bullish piercing line pattern, I might say. But it's essentially where you have a long down day followed by a long up day where you close at least halfway above the body of that candle. That looks like what we would have had. That's short-term bullish, that's constructive. And again, the idea of that is you've had demand come into the market during the trading day. One of the things we talked about yesterday was the RSI indicator and where it is relative to its overall range. And the fact that the RSI dipped below 40 is kind of interesting. We'll have to see what happens from here. If we would not go any lower, if this is it, that might actually be a pretty interesting short-term, bottoming pattern, for example. But again, we'll have to see with 1 day, it's 1 day after a number of more distributive patterns. So the question is always what sort of follow through we might get. I want to switch a little bit and just look at, sorry for shooting across a ton of charts here. I probably could have organized that better, but we're going to go to some of the breadth indicators. So I think breadth is actually really interesting to pay attention to. This was a chart we looked at yesterday. If I remember right, it was one of our 3 and 3 or something we certainly referred to. And this is the breadth by cap tier. So it's essentially showing you the closing price of the S&P 500 at the top, And then it's the market breadth by cap tier. And you might have noticed I just refreshed the chart because I was just updating these earlier. When we looked at this yesterday, we had the small cap breadth, the cumulative advanced decline line had gone below this support level. And this is the level I took from the peak in May, the peak in July, and sort of said, as long as we remain above that, breadth is remaining pretty positive because so many people got so excited about stocks when the advanced decline lines are going to new highs right at the beginning of the month. But if you look at what has happened now, the small cap index has gone below, and then through today's price action and yesterday's, we have the mid cap index now going below, the NYSE broader index going below. So really the only one that hasn't gone and broken below that resistance level is the S&P 500 itself. And that shows you a lot of times where the broad index will look one way, but if you look deeper, if you look underneath the hood, if you look at breadth measures or even some individual stocks, you might find some different patterns that may or may not have been reflected sort of on the broader index, or at the very least it'll look a little different. So I think that's one thing you want to pay attention to is just the overall breadth environment. Another one I want to look at, going here very quickly, this was a chart we've looked at before, which is the percent of stocks above the 200-day and also above the 50-day. And what we've talked about over the last couple of weeks on Market Watchers Live a little bit, and then on the final bar this week was, look at as the S&P has gone higher, look at the successively lower highs on this breadth indicator. This is the percent of S&P names above their 50-day moving averages. So as stocks keep trying to push higher, less and less stocks kind of participating or remaining above that short-term trend following mechanism or smoothing mechanism. And what that suggests to me is an inherent weakness underneath, right? With less and less stocks really participating, it's becoming more narrow. The number of names that are able to move higher is narrower and narrower. So those are a couple of breadth measures I'd certainly suggest you pay attention to. In a little bit, we're going to do a deep dive on the consumer discretionary sector. So I just wanted to orient ourselves, maybe start with looking at the relative rotation graph of all 11 S&P sectors. And again, to orient you here, further right means it's outperforming, further left it's underperforming, and the vertical axis, the y-axis, sort of the rate of change, the momentum of those rotations. Julius de Kempener, who is one of our contributors, knows this and created this methodology, speaks to it very well on his show. So I'd encourage you to check out his sector-related show. But if you look, it's clearly a move to defensive sectors, right? Utilities, real estate are now the strongest and accelerating to the upper right. This is on a weekly basis, so it's showing you that rotation to more defensive groups. Tech, consumer discretionary that we're going to talk about today, sort of in the weakening and rotating lower category. Energy has been sort of the outlier further down in the lagging quadrant. A couple of really interesting ones, and some of the more interesting charts I've seen have been in healthcare, actually. Maybe tomorrow or next week we can dig into healthcare a little more deeply, because I think there's some interesting chart patterns to pay attention to as well. Having said that, I want to rotate into our next segment, looking at a sector deep dive. And essentially, one of the things we talked about doing with the final bar was, making sure we take a step back and focus on some of the individual sectors, right? Some of the stocks and patterns that are moving within each sector. What group themes we can try to unpack. Because I think, to be honest, that's the power of a platform like StockCharts, is the ability to take the high-level analysis, but then drill down into the types of names and types of patterns that you think are of interest. So I'm going to just break down the consumer discretionary sector a little bit, and then we're going to look at a bunch of stocks here real quick, and then have my guest, Mark Newton, join us momentarily. So this, again, is the relative rotation graph, but now instead of looking at the 11 S&P sectors, I'm actually looking at all the S&P names within the consumer discretionary sector. So it's a lot of tickers, and so I just brought it down to the last couple weeks so we can see some movements. And again, in general, stuff in the upper right corner like Target is sort of the long and strong, doing pretty well. Things down here like Macy's, Ulta are sort of in the unattractive category, underperform. This is all based on relative performance, by the way. And then as it rotates higher, it's starting to increase the probability of further gains, and over here sort of getting hurt on a relative basis, and the momentum is slowing. So we're going to pick out a couple of these charts, a handful of them, try to go through them. And as we do that, I'd ask you to start thinking of the consumer discretionary sector as a whole. How does this start to look? So the first place I want to look is, if you look, a number of these tickers stand out to me as charts that I know I've brought up because they've bubbled up to the top of the screens. If you look at the scooter rankings, some of these home builders like DHI, like LEN, Lennar Homes, what else? Pulte Homes, PHM. These are all stocks that have sort of bubbled to the top of the list here. We're going to look at Lennar Homes, LEN. So, again, what's really interesting about the equity space is even with the market, with all the volatility, with the downside pressure, with the VIX spiking, you have stocks like this that if you didn't know all that was happening, you'd probably feel pretty good if your portfolio looked like this, right? This is a stock that has completely ignored the last couple of days of down movement in equities, has just broken to new highs. It's this great accumulation pattern, higher lows, higher highs, breaking above resistance. Really compelling pattern. A lot of the home builders are in this sort of pattern, new price highs, new relative highs. The RSI getting, overbought and maybe increasingly so, but that can be okay. When a stock's had a good run, you'll get the RSI become elevated, and it can stay elevated for quite a while. So if you look at Lennar Homes on the left side of the chart, sort of late 2018, sort of got up in that region and stayed up there a number of times, and that just meant the stock's going up a lot. That's kind of what you'd want, right, as an investor in the name. So home builders overall are a pretty bright space in there. Let's bang around through a couple of these others, all of which have appeared on the relative rotation graph. But just for the sake of time, I want to go through some of the names rather quickly, maybe. This is Tractor Supply Company. It's part of the specialty retailers section, which has kind of a mishmash of different businesses. But, and again, if you've known my work, or you've followed my work, this is not sort of my main go-to sort of buy idea. I don't tend to like things that are weak. I like things that are showing overall more signs of appreciation. I tend to like things more in this range that are, showing a longer uptrend and pulling back to some short-term weakness. This one's a little different, right? This has been in a distributive pattern for the last couple months. Lower highs, lower lows. We just made a lower low. We've potentially made a new high, or a new swing high, and that's why I think it's sort of interest. A nice up move today as stocks rallied. The RSI recently was at 30, which a lot of times can be a buyable point. I like the fact that the relative strength has improved, but again, for me, I'd love to see some follow through. You'd love to see some further upside, maybe establishing a higher low that would feel a little better about what we're seeing there. Next one we're going to go to is Starbucks. I was talking with Dan Russo, who's runs his show. He mentioned I like stocks that I know. It's a classic Peter Lynch methodology, and very few of us would not know Starbucks maybe intimately from our daily or morning routine of going there. But this is a really compelling chart right here. Starbucks has at times been sort of the classic poster child for a consistent uptrend, something that's just worked, right? So if you look over the last 6 months, 10 months, 12 months, you've had this beautiful uptrend, relative outperformance. It's just been a great long-term winner. That's all started to rotate, right? We can see the rotation of the relative strength from positive to negative. We can see the RSI go below that crucial 40 level. But now it's oversold. It's right potentially at a place where it might bottom out. We'll have to see. I don't have the Fibonacci retracements, but if I start there and put them there, I actually believe they're right around 80, 79 to 80, which would line up with the 200-day moving average. So the reason why this kind of comes up on my list of potential ideas is just the fact that we've sold off and we pulled back, being oversold to a place where I might expect some support to come in, and we're now in that arguably buyable range if you like the long-term story, like the long-term play. But again, for me, I'd always want to see some sort of signs of accumulation, signs of upside. Target is one that's been on the top of the scooter rankings. You can see on the large cap rankings here at the top, 99.9. That's top percentile of all the stocks based on our technical ranking system. This is a stock that gapped higher and now has settled down a little bit, but overall still in a really compelling technical point. We gapped above this beautiful resistance level, have remained higher, nowhere near the 50-day moving average. One of the better places to be. And other names in a maybe related space, this is getting into more restaurants, things like Yum Brands, at times have been some of the best charts in consumer discretionary. And this is one that, again, pulled back a little bit. So I like the fact that it's in a long-term uptrend, pulling back arguably to a buyable level. This is what you might call a pennant pattern, depending on how you measure it. We may have just broken above that upside there. So you'd want to see, again, some potential rotation further, but an interesting chart here. And then the fact that something like Nike is gapping above resistance and holding up above 90 pretty well. Nice, compelling story. And I like the fact that the relative strength has done well. So what does not look good? I'll go quickly. Cruise lines actually don't look too bad on the relative rotation graph, but the individual charts are pretty brutal. This is RCL. You could look at Norwegian, Carnival, kind of similar patterns to me. If you're more of a deep value sort of person, this might be of interest, but for me, I'd much rather see a short-term bottom. We had sort of a bullish engulfing pattern-ish today, so we'll see if that has to follow through. I would also say some of the hotels, looking at Marriott and Hilton earlier, these are stocks that have broken down through the 200-day, broken down through support, just put in a lower high at the 200-day. And, in my opinion, the types of charts you probably want to stay away from overall, given the fact that there are just better charts in the consumer space. That was a quick run through. I tell you, a sector deep dive could be a 3-hour experience. So that was a very abbreviated version, but hopefully gives you a sense of where some of the names are. There's a lot of different chart patterns, a lot of diversity there. We're going to take a quick commercial break. I'm going to come back with my guest, Mark Newton from Newton Advisors. Be right back.
The Chartwatchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chartwatchers newsletter.
Hello, everyone. Dave Keller with StockCharts.com. Thanks so much for coming back on the final bar. Good to have you with us. Also joining us today for the first time, Mark Newton from Newton Advisors. Mark, I've known you for a number of years, and it's such a pleasure to have you on. Thank you.
Thank you very much, Dave. It's great to be here. Thanks for the invite.
Of course. So you sent a couple charts, and I'd love for you to just talk through them and talk about what you're seeing. The first one was actually really interesting because it's a really long-term chart, a long-term monthly chart of the S&P. What does this tell you?
Yeah, I thought I'd sort of bring a longer-term perspective to your show and really take a look at how the S&P looks. So, a lot of people look at things on a very short-term basis, and oftentimes it's nice to just have a longer-term view. And you see the S&P on a monthly chart, you see the 10-month moving average. A couple of things stand out. One is that, as you noted earlier in your bit, momentum has really started to tail off pretty dramatically. We're seeing a lot of negative momentum divergence just on the right-hand side of the chart. I think that's interesting. We really hit the highest overbought levels we've seen in over almost 20 years back in January of 2018. And on subsequent higher highs, momentum has actually nosedived. And even recently, it's really started to tail off badly. So that is a little bit of a warning sign. But I think, as you know, it's proper to wait for evidence of deterioration. When you look at those prior peaks, you see back in 2007 and in 2000, we also saw evidence of momentum deterioration and really waning divergence. But it's really important for the average to cross the 10-month moving average and for the average itself to turn down. Now, when that happened back in 2000 as well as in 2007 and got under that 10-month, really it stayed under there almost for the entire bear market. So for those that are looking for really a longer term, if there's one indicator, one thing you use to say, all right, am I in stocks? Am I out of stocks? If you wait for this 10-month to really roll over, and when the S&P makes a monthly close under that, and really just say, okay, if it's under it on a close, then I'm out. If it's above it, then I'm back in. It really can help in terms of risk management to keep people out of the market when we started to turn down.
That's fantastic. And it's such a great reminder to keep a long-term perspective. I think we get so caught up in the short-term volatility, especially now in a choppy week, right? The second chart you sent was growth versus value. Can you talk us through this?
Yeah, so this is a ratio chart of the iShares S&P Growth ETF, the IBW, over an iShares S&P Value ETF. So the growth over value plotted out in ratio terms. And you can see that largely it had been rather sideways for almost 7-8 years until right after the election, and then it really started to turn higher dramatically. We have been in a very rapid growth phase over the last few years, up until the last month, and we really saw sort of a shot across the bow with momentum turning down very sharply, and that coincided with this ratio actually breaking the trend line from 2016. So I view this as definitely something that would indicate that value should look a little bit more attractive in the years to come. We're seeing definitely some evidence of growth waning. The bottom part, you see just a 14-period RSI, relative strength index, and we actually saw some negative momentum divergence on that recent peak into this year. So we did have a little bit of advance warning that potentially it could happen, but as always, it's proper to wait for the actual break, and I think we've seen that in the last month. So for me, that's definitely a warning that, growth could be, starting to falter, and one might want to, favor more value versus growth in the months to come.
Well, you talk about a different environment than what most investors have been dealing with, right, for years now. If that follows through, I think that would catch a lot of people potentially on the wrong side of things. Finally, you sent us one final point to make on that is, even if it were to move back to new highs into year end or into early next spring, the momentum has rolled over so dramatically that it's going to be difficult to really regain those former peaks. And so, it is sort of a warning when momentum really starts to dive like that, and so that's proper to put into perspective. Perfect. And then finally, you sent us a chart of mid caps relative to the S&P.
Yeah, this is the S&P Mid-Cap 400 Index over the S&P, and a lot of people put their focus on small caps and have noted that small caps have been going down for years, and that's true. They really peaked out in 2014. But it really is the fact that mid-caps have also started to really deteriorate of late, and I think that is potentially a bigger concern on an intermediate-term basis. Oftentimes, when you look back over the last 100 years, bear markets start initially with small cap deterioration, and then mid cap, and then finally large cap. And we've seen that small cap, but really recently the mid cap has joined, and now we see a break of this consolidation that's really been ongoing since 2010. For me, that's definitely a concern that mid cap is starting to wane. And as we all know, in the last 12 months, it's really been proper just to be in large cap growth, and now growth is starting to falter a little bit. And so it's really interesting, a lot of the style shifts that we've been seeing of late.
These are three fantastic charts, Mark. We're out of time, but I'd just love to ask one quick question of you. So it's definitely painting a more cautious picture, it seems like, from these long-term charts. What would you need to see very quickly to maybe suggest that this is incorrect, that maybe we're going to see further upside? Is there a particular tell or signal that you'd be looking for?
Well, I think the longer-term charts certainly are still in a good shape price-wise. And so, the intermediate-term trend for me is really going to be bullish unless we take out August lows. And so for me, that's really the key that we're really going to start to accelerate lower. Until that happens, I don't rule out the fact that we can rally out of this. October obviously is still a very volatile month notoriously, and we've seen a little bit of volatility of late. And so, it might be interesting over the next 4 to 6 weeks. However, my thinking is, we're heading into a seasonally bullish time, and pre-election years, obviously, between now and year end into next spring, we could potentially rally out of this. It's more when price starts to confirm what a lot of these other warning signs are showing us, and I think that's really what investors need to pay attention to.
Mark, thanks so much for coming on the show. That was fantastic. What a great take on the big picture, and thanks for going through the long-term tells with us. Really, really helpful.
Thanks, Dave. Great joining you. Look forward to doing so again soon. Take care.
Ladies and gentlemen, that was Mark Newton of Newton Advisors, and I hope you appreciate some of the guests we have coming on. These are the people that the pros listen to, so I hope you've gained a little from hearing their take on the world. I want to rotate. One of my friends, Greg Schnell, fellow contributor to StockCharts.com, broke down indicators on indicators, how to look at technical analysis in a Talking Technically segment I wanted to share with you. Here's Greg.
Okay, what I want to talk about today is how to put overlays on your indicators. So as an example, a moving average on something like the RSI or a horizontal line on the scooter ranking or something like that that you can set up. So how do you do that, and how do you control the colors on those? So the first thing I want to show you is an example of the moving average would be, this wavy line on the RSI. An advantage of a horizontal line would be this flat line on the SCTR ranking. So let's go see how we set those up. So down here under the profile panel, we've got indicators and we've got the scooter line. And then over here on the far right-hand side, when you expand out this parameter box, you'll see that there's a horizontal line option, and you turn that on, and then you type whatever level you want it at. So in this case, I want it at 75. And then if you use the colon blue, that'll change the color. Now, if I set this up to be red, it'll obviously give me a red line, and the same thing with this moving average. If I wanted it to be green, I could just change it like that. And so on the RSI, I've gone with a simple moving average and set it to be a 50 period moving average, and then the color is green. Up here on the horizontal line, I've set it at 75 and the color is red. Now we'll just shrink back our screen, and when I hit update, what you'll see here is the line is now red and the moving average is green, and that's how you do an overlay on an indicator.
So folks, that was Greg Schnell, fellow contributor to StockCharts.com, breaking down the idea of putting overlays and sort of indicators on other indicators. You know, as I've learned how to use StockCharts more and more over the years, being a customer and now working at the home office here, I've learned the most from learning from people like Greg that use it way better than I ever will, I feel like. So, you know, you have a chance to learn from some of the experts, and it's always a really good way to upgrade your own game using StockCharts. I want to pivot now to talk about the 3 in 3. This is the final segment we like to do every day, just breaking down 3 key charts that you should be paying attention to, and if not, I'd encourage you to put them on your own list. And again, everything I show here, you can create on your own login. You can save it to a chart list and come back to it anytime you want. The first one, we've talked about breadth in a number of ways, and you know, my segment with Mark earlier talked just a little bit about some of the breadth and how it's rotating. You know, in this case, this is the new highs on the NYSE and the new highs on the S&P 500. I like to look at this bottom clip more than anything because we're looking at a chart of the S&P 500, and then we're looking at how many of those names that comprise the index are going to new highs and going to new lows. And in an extended up move, you will find that new highs indicator gets really, really high, right? It'll continue. And every time we push higher, there are a lot of stocks up there. When the market starts distributing, you will see the new lows sort of come out of nowhere and really accelerate to the downside. We have certainly not seen that yet, but you can see how this is starting to emerge. We've had a period of a month or so with literally almost no new lows because so many stocks are sort of above support. That may be starting to change here. And here, for one of the first days in a long time, we've had an even number of new highs and new lows almost. So that's something I'm certainly keeping my eye on. I'd encourage you to do the same. I've not liked the fact that as the markets rally, we've had lower new highs. So I think that's an important one. The VIX is the second one. And if you watch the show over time, I'm actually not a big fan of looking at the VIX too often. I think it's interesting, and I like understanding the volatility picture, but I'm not a fan of relying too much on the signal of the VIX, only because it looks kind of high until it gets a lot higher. You know what I mean? And it's sort of the opposite of, you know, never confuse the bottom of the page with support, never confuse the top of the page with resistance. And just because something's gone up a lot doesn't mean it can't just accelerate way beyond what you would potentially expect. Where I do think it's interesting is to take the current level in the VIX and what's happened and relate it back to previous regimes and see where we're at relative to where we've been. And if you see, we're getting up to that range of the VIX just above 20 yesterday, where it's where things are at after a nice run and after we start to pull back a little bit. And so that's sort of the pattern I would be looking for, seeing if we top out in that range for the VIX. And then very quickly, we talked about consumer discretionary today, but just want to highlight with the bank index, part of the financial sector, obviously. We'll have to see how things play out here, but you know, a lot of accumulation, obviously, on the short-term picture for a lot of markets. The BKX actually had bottomed out from support from earlier this year. Today, we have a candle, what you call a hammer candle. You think of it as hammering out a bottom, a short real body here with a long lower handle or lower wick. Essentially, we opened, traded lower, then closed back above the highs of the day. Usually, you know, suggests some short-term strength, some short-term accumulation that often, you know, continues the next day or two. So we may see a little bounce in financials here on Friday, then into Monday. We'll have to see if that candle pattern plays out as expected. Ladies and gentlemen, thank you again, as always, for joining us here on the Final Bar. We did not get to a mailbag today, but we certainly will in future days. And I appreciate so many of you sending questions that have been really, really thoughtful. I'd encourage you to continue to do so. Just shoot me at the Final Bar at StockCharts.com. That's the way to get to us. Also on Twitter at FinalBarSCTV. I want to thank my guest, Mark Newton from Newton Advisors. Have a great evening. See you tomorrow on the Final Bar.